Hey, how you doing? And welcome back to another episode of The Rules of Investing, a podcast that gets inside the minds of leading investors, economists and industry experts, brought to you by Livewire Markets. I'm Ali Selby, and in the last episode, you heard from Global X ETF Scott Helstein, who discussed his unique background, which informs his current take on geopolitics, the appeal of thematic investing, and the concept of following the puck. This week, it's all about property. Residential property markets have continued to soar higher despite Australia's aggressive rate hiking cycle. Listed property markets, on the other hand, have been under pressure in recent years, with many companies moving to a hybrid work-from-home model post-COVID, high construction costs and concerns around lending. However, according to this week's guest, who's Resolution Capital founder Andrew Parsons, investors are missing the mark on the key opportunity now available in listed property markets. He argues that many assets are now trading at or below their intrinsic value. In this podcast, we'll discuss the opportunity that Andrew is seeing in listed property markets today, as well as some of the major trends that are shaping property investments and markets. If you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so you don't miss an episode. Or if you're a Livewire subscriber, hit the follow button at the bottom of the wire to be notified when new episodes are available. Not a Livewire subscriber yet? What are you doing? Just head on over to livewiremarkets.com. It's free, easy to register, and you'll get access to insights from leading investment minds in the country. Okay, let's get on with the show now. Thank you so much for joining us on the Rules of Investing today, Andrew. Really excited for this chat.
Oh, thanks, Ali. I hope I don't disappoint.
You definitely won't. Resolution Capital is celebrating its 20th anniversary this year. Congratulations. I want to know your first experience with property investing, kind of what got you or kick-started your love affair with property.
Sure. So, to be quite honest, I started off in broking, and I think I was fresh out of university, and back then, real estate and REITs were certainly not one of the faves of investors and brokers. Nothing's changed, which is great. And I just saw that this was, to me, a really fascinating part of the market that was underappreciated, more dynamic, and at the time it was going to be facing some pretty challenging conditions. And I thought that would be the time to really get in and see what unfolded. And so, this was back in the late 80s when the real estate market was sort of just on the fringe or on the edge of a collapse. And so I was very fortunate in being in the right place at the right time in terms of seeing something unfold so dramatically, but then that created great opportunities. So for me, I heard you mention the puck from your last speaker. Yeah, I think Wayne Gretzky always said you've got to get to where the puck's going to be, and I think I managed to do that. So that was, I think, fortune, but yeah, definitely the fact that nobody else was interested in it sort of piqued my interest. And 30 years later, I still haven't mastered it, but I'm still enjoying it.
I love that. No, I love the idea of being in the right place at the right time. I feel exactly the same with falling into finance journalism. Let's go back to basics now. Distilled very simply, what is a REIT?
Yeah, sure. So a REIT is, it's to all intents and purposes, it's a trust or a company that is dedicated to long-term ownership investment in real estate. So it's not a trader. It's not supposed to be doing multiple other activities, certainly of any substance or materiality. So it's dedicated to buying, owning, leasing property, to then distributing the majority of the income as distributions, as would be the case if you owned the property itself. So the idea is that you're then able to buy very substantial properties that an ordinary small investor, medium investor, in fact some large investors, couldn't own directly themselves. This is basically a way of gaining exposure to the underlying real estate returns of these platforms that are invested in a range of different real estate types. So we're talking office buildings, yes, but I have to stress that's a small proportion of the benchmark. We're talking about shopping centres, warehouses, student housing accommodation. We're talking about healthcare facilities, hotels. So it's a complete range, self-storage, it's a complete range of different real estate types that wouldn't ordinarily be available to investors. And for us, it's that focus on the underlying real estate that matters most, because that's effectively what we're getting an interest in.
I feel like it's fair to say that Australians have a love affair with property, particularly residential property. What is the difference between listed property, REITs, and unlisted property?
Well, if it's a do-it-yourself situation with unlisted property, it comes with a lot of challenges, not least of which is the operational side. So you've got to manage the property, lease the property, maintain the property, deal with all the tax issues, et cetera, et cetera. With a REIT, you literally buy a unit or a share in the REIT, and hopefully they just pay you a distribution at least once a quarter, if not twice a year. And as a consequence, it's a very simple way to gain exposure to the underlying real estate that relieves you of all the day-to-day hassles. Anybody that owns, for example, their own owns a residential property knows that it is very time-consuming, and the outcomes are not always assured. Now, what we're able to do, as I say, is buy interests in real estate that are professionally managed by some of the world's best real estate managers and operators, who are able to get the best returns from the real estate and pay us a distribution every quarter. They report to us every quarter about how they're going, how the leasing's going, how much money they're having to spend to attract tenants, to retain tenants, any acquisitions they might make. So we are very much involved in understanding what's going on at the real estate level. But the great thing is we don't have to do all the day-to-day challenges, and we outsource effectively to some of the world's best real estate operators that own some of the world's best real estate. And you're getting, I guess, diversification. You're getting, as I said, a whole range of different real estate types. And you're getting diversification away from the Australian economy. So we're able to buy REITs that are located in the US, in Canada, in many parts of Europe, in the Asia Pacific region. So for us, it's the quality, it's the diversity, and it's also the liquidity, right? That's one of the things that investors constantly underappreciate. It's the ability for you to be able to liquidate your investment at basically very short notice. I think we offer, it might be 2 or 3 days maximum in terms of getting clients' money back to them. We sell a share, we settle, and then we return it. Whereas with an unlisted vehicle, it's always subject to, you're always subject to somebody wanting to buy the property or put units into an unlisted fund to be able to redeem your interest. So that's why through my career, I've seen periods where people have had their money frozen in unlisted real estate funds, and that causes enormous duress and distress in terms of not knowing what they're going to get back, when they're going to get it back. Whereas with us, it's very transparent. Yes, the market can be somewhat volatile. We agree that's an unfortunate outcome, but it's transparent and it's liquid. And if you are a long-term investor, you're going to get the underlying long-term returns. And that to us really is an underappreciated package. Best quality, diversity, geographic, sectoral, and liquidity, best operators. We think it's a pretty compelling argument.
If you could only hold one, let's say you could only hold a investment property or a REIT, what would you hold?
Well, Ali, I'll be honest. Of course, I've been around a while, so I do own both, and I don't have a large residential investment portfolio. I've got a couple of interests, and I'll tell you all day long, I would own the REITs because I think people underappreciate the time and effort that's involved in it. They underappreciate the risks. Obviously, residential has been in this country being fantastic for quite a considerable period of time. I get that. But the reality is that most people have already got a significant investment in their own home. So they've got enough exposure to the Australian residential market. Yes, you get negative gearing benefits, and I get that with owning an investment property. But for us, as I say, it's the fact that we've got a wide range of tenants, industries, property types, geographic locations, and we just pay people a quarterly distribution. So, and over the long term, what you should expect is basically an inflation plus maybe 300 or 400 basis points. We don't seek to set the world on fire in terms of returns. It's supposed to be about something that sits between a fixed interest investment and a broad equity, and that's been the long-term history. The great thing at the moment for people who are considering the space is, and as part of your introduction, we're now facing a set of dynamics very unusual in the property cycle. We're actually buying at very good prices at below intrinsic value. So that sets us up for, we think, a particularly strong 3 to 5 year period after obviously what's been a very weak past 3 to 5 years. So look, timing, we were just talking a little earlier about jokes. It's all about timing. And investment, unfortunately, there is some degree of that, especially if you're only investing in the short to medium term. If you're a long-term investor, hopefully that takes a little bit of that out of it. But we do think it's a particularly interesting time to be considering the space. And no doubt we'll talk about that.
Let's stick with that now. What are you seeing in terms of valuations within the REIT market? Okay,
so very quickly, when you buy real estate, you're buying two components, the land and the bricks and mortar, right? At the end of the day, when you're buying a property. Now, what's happened is in the last 5 years, anybody who's renovated a home or built a home will tell you that prices have gone up extraordinarily. In fact, what we're seeing is commercial building costs have probably gone up in the range of 30 to 40% in the last 5 years, right? Now, as a consequence, when we look at the value of a property and we know the building costs have gone up 30 to 40%, what we've seen in commercial property terms is that the end values have actually gone down 20%. So the building costs have gone up 30 to 40%. The property value, the overall value, has gone down by 20% on average. So that means that we're paying not much for land. In fact, in some cases, you're getting the land for free.
Wow.
Now, what that suggests is that your values are underpinned because the bricks and mortar, they don't go down in price very often, right? Again, they typically go up moderately. We've seen a spike, and then they'll tend to flatten out. But we very rarely do we see a significant decline in building costs. So as a consequence, anybody that wants to build today, they will need to get a much higher rent to justify the new building. So as a consequence, if I'm an existing owner, that means my underlying value is underpinned by intrinsic value, the replacement cost, and anything new that is going to be built to compete with what I own, the new developer will require a significantly higher rent. So that makes it a very, very difficult competition for new entrants, new developers coming in. And that, by the way, is why we're seeing a significant increase in, and it's been well documented in the press, we've seen a big pickup in delinquencies of construction companies. It means that development is very, very difficult. And as a long-term investor in real estate, that's a great thing because it means you're going to face less competition. That means that you will have pricing power. And so as a consequence, as I said, the two critical outcomes of what we're seeing is we've got a bit of a floor under values, and anything new that is built will require significantly higher rents, which means existing cash flows or existing rental levels we should see some pretty material growth over the next 3 to 5 years.
It's worrying on that construction issue just because Australia needs so many new houses and apartments to keep up with population growth.
Yeah, you're absolutely right. And this is no doubt one of the great challenges and why we're not seeing a big, despite this chronic shortage, we're not seeing a big increase in construction. And that again highlights the issues that I'm talking about. And it's unfortunate for people in the residential market that we're not seeing the supply. And this is what I'm talking about. And we're seeing it in commercial real estate more broadly, that the costs are so prohibitive to bring on new supply. So this is a situation that's going to be very difficult for us to work our way out of. It'll require a lot of things to go well for us, including governments have to come to the party. I mean, it's pretty ridiculous in this country. We've got federal, state and local policies. The federal government's encouraged, and believe me, I'm not blaming immigration. I'm just highlighting the dynamic, the tricky dynamic that the federal government dictates immigration, but it's the state and local governments that dictate planning. So as a consequence, we're getting this inconsistency in policies. And again, I'm not blaming it all on immigration. Please don't, but I'm just highlighting that as an easy example, that there is a disconnect in terms of the big picture planning And housing, unfortunately, the NIMBYism, nobody wants more supply, particularly in existing areas. But that's the most efficient place to build. We don't want urban sprawl. It's proven over time to be too expensive to maintain, and the infrastructure that needs to go in. The most efficient way we can grow our supply, our housing stock, is more supply in existing areas. But nobody wants that. So we're in a very tricky position. Not only don't we want it, but the costs have gone up. So it's going to be a very challenging work through this problem. And by the way, it's not just Australia that's facing this. We're seeing this in many markets around the world. So it's the governments that are proactive and constructive and are able to bring on infrastructure, amenities, and thoughtful supply that will create the best cities. And that's what we need. We can't close our eyes, shut our eyes and pretend it's going to go away. We've got to be constructive about it. And it obviously, there's so many different vested interests. It's a hard one to resolve. We've seen in some markets, governments trying some Bandaid solutions like rent controls. Believe me, it backfires. It just means that developers won't build, because why would I build to something where the cash flow is going to be restricted? Secondly, all it does is it dissuades existing landlords from keeping the properties in good condition. Because if I'm not going to be paid an increasing rent to justify spending on refurbishing, renovating, maintaining a property, the stock deteriorates.
What's the solution then, though? Australians can't just keep paying higher rents and higher rents.
The solution is that you can be negative, and what you'll do is you'll actually make yourself unaffordable, and people will leave and cities will deteriorate, and then it doesn't become a desirable place to live. I mean, Sydney, Melbourne, Brisbane, Perth, Adelaide, trust me, travelling the world, these are desirable places to live. Well, guess what? That means they're expensive because everybody wants to live there.
Yeah. One
solution is to make them undesirable, and then rents will fall and everyone says, we've solved the problem. That is not the way to solve the problem. We need to do it take a medium to long-term view, and that means basically hand-in-hand planning with state, federal and local governments to create amenity, to create infrastructure, to create thoughtful supply, because it's the supply, it's the solution. But, I mean, just talking out loud, you can tell it's pretty difficult to resolve this issue.
I want to step a little bit back. There's been this ongoing narrative over the last 3.5 years of weakness in global REITs, thanks to rising interest rates, the demise or supposed demise of the office sector, and lending concerns. And you talked also about higher construction costs as well. Is that still the case today? Where are you seeing the most stress?
So, look, the most stress, it has to be in the office market, and particularly the B-grade office, because what's happening is that tenants are becoming more discerning. They know that in a relatively tight labour market, to attract talent, which is the key, they need good quality space. And if you don't have good quality space, you will not attract the talent. And if you don't attract the talent, you don't have a business. So they're all working out that it's not about the rent level. So B-grade can cut their rent as much as they like, but it's not going to attract tenants. So B-grade office space is definitely the area which is the greatest challenge. And the problem for those owners is that they know they will need to spend enormous amounts of money to reposition and upgrade the buildings to a higher grade, or to repurpose them for an alternate use. That is a very expensive process. So those owners of B-grade office buildings are in a world of pain. Now, fortunately, as far as the listed REIT market's concerned, that's a very small proportion of the assets.
What percentage?
It would be, B-grade office would be less than 2.5% of the benchmark.
Tiny.
Okay, overall office is less than 10%, and the REITs typically own better quality property and better quality office buildings. And that's why if you look at the office REITs occupancy, they're above the national averages for the office markets. So broadly speaking, the listed REITs, it's a small proportion overall, but what they do own is very good. And interestingly, in some of those markets, they're actually seeing rent growth in good quality office because of this focus, this gravitation towards better quality buildings where there's a shortage.
How do you think about returns? I feel like before you were talking about distributions, that reliable income. how do you think about returns in terms of income versus capital gains? And then where does REITs or property fit within a portfolio?
Yeah, well, we'd like to think it's a balance, right? There is a mix of capital growth and income. So, and that's been the history. If you look at fixed interest, obviously it's basically all interest. If you look at over the long term, if you look at equities, it's mainly weighted towards capital gain, the component of income. Whereas REITs, it's more of a balanced return profile. And that's why it should be a sort of seen as a store of wealth that grows over the long term in terms of that capital base that also generates a healthy distribution yield. But we stress, we are not about an income product. This is a total return strategy, but there is definitely a component of income as part of that.
How do interest rates play into returns, and how do returns compare to equities and then fixed income?
Sure. So, look, at the end of the day, of course, interest rates matter. Interest rates matter to everything, right? It's no point pretending otherwise. I mean, we saw one of the worst bond markets we've seen in 50 years. And to think that there's not consequences of moving from QE to QT, and we had this thing, remember in international markets, called negative interest rates. I mean, that was so distorting, and it distorted real estate markets. And so we're seeing that wash out now that that's been reversed, if you will. So that's washing out. And as a consequence, what we're seeing is that, interest rates look like they've reached an inflection point. And so hopefully that creates a little bit more confidence for investors more broadly. But, for us, it's not about interest rates wholly and solely, because it's about the underlying real estate fundamentals. Real estate is about supply and demand. I mean, Ali, when I started out in real estate in the 80s, late 80s, it was an inflation hedge. Then inflation fell in the 90s, and the real estate industry said, oh, well, how do we promote ourselves now? I know, we're a yield play. Now that, of course, interest rates have jacked up, they're all going, well, what do we sell ourselves on now? I know, it's an inflation hedge. The reality is that real estate is a simple game. It's about supply and demand and how much debt, right, is involved. And fortunately, what we're seeing broadly is that the supply and demand operating conditions are actually very good outside of a couple of areas. I mentioned B-grade office, but in most sectors, it's actually very positive. Probably among the more positive in terms of promising, in terms of the lack of supply and high occupancy. And on the debt side, the REITs have, I guess, learnt lessons over the last 20, 30 years. And so they've actually been generally been deleveraging. So the REITs are actually in a very strong position. Not only have they been deleveraging, they've been accessing different forms of debt that's not typically available to private investors. So most of them have investment grade balance sheets. That opens them up to be able to borrow in the capital markets, right? They don't rely just on bank debt. They've got multiple sources of debt, and they don't have a lot of debt. So that means that the REITs are actually very well positioned in these more challenging circumstances, and hopefully in a position to take advantage of the distress or duress of private real estate investors who are struggling at the moment. So for us, it is about the fundamentals of real estate, not about interest rates. Interest rates matter to everybody. I'm not saying they don't matter, but I think people overestimate the effect. If I've got terrible supply and demand conditions in real estate, it doesn't matter what interest rates are. It's all about the operating fundamentals. And at the moment, I stress, we've got high occupancy and low supply in most real estate segments, and we've got strong balance sheets. So that sets us up for a very good period ahead.
How much of the portfolio is invested here in Australia, and how does that compare to overseas?
Sure. So today the global strategy has about 3.5%, 4% exposed to Australian real estate. The rest of it is the US at about 60%. We've got Canada at about 3 or 4%. UK sitting at about 11, 12%. Europe at about 9%. In Asia, we've got about 4%, just under 4% in Japan, and 2% in Hong Kong. So it's broadly diversified. But what we would probably prefer to say is that we focus more on sectoral diversification than geographic. And so when you look at what we're invested in, we've got 20-odd% in residential. Now, let me be clear, this isn't trading development residential. This is single-family home rentals. These are apartment rentals. These are student housing, manufactured home communities. So it's a broad range of residential types where we're seeing, again, like Australia, very strong fundamentals. We've got a substantial exposure to retail. That's at about 18%. Now, that's a fascinating area because everybody's had this expectation it's the end of the world for retail. And what we're seeing is we call it the quiet recovery of retail. Retail is an area which, a lot of people have a bias against, because for a lot of people, going to the shopping centre is not something that they look forward to. But the reality is, it is social infrastructure. You get out of the house, and more often than not, you end up somewhere around a shopping centre during your week sometime. And it is still the most effective and and profitable way for retailers to sell their goods and services. Now, the goods part obviously has been subject to a fair bit of competition from e-commerce, Amazon, for example, obviously. But what the retailers are working out is delivery to the home free of charge, believe it or not, surprise, surprise, doesn't make money. Their most profitable sales are through shopping centres. I'm not talking Amazon, I'm talking retailers. And even Amazon and some of the e-tailers have been looking at a physical store presence because of the importance of what's called omni-channel. So selling to consumers through multiple forms. And bricks and mortar, when you're in the right catchment area, is still a very effective way to sell goods. And then there's services, which it's very hard to do in terms of providing health and beauty, for example, in the home. You have to basically go somewhere, and shopping centres have incorporated more health and beauty, gymnasiums. Obviously we're seeing also in many cases pet care, for example. So restaurants, food, these are areas of where services are thriving, and therefore in the US and in Australia to some degree, but in the US more interestingly, we're seeing vacancy rates in shopping centres at multi-decade lows.
Wow.
Because retailers have realised we've underinvested in our stores. We were so focused on home delivery, and then we've realised it doesn't make money, and we've got to meet our consumer in multiple ways. And so what we've seen is very good tenant demand. Many tenants, retailers are looking to expand their store footprints. And the other thing, I come back to that supply and demand dynamic, we haven't seen new shopping centres built in any scale for over a decade. So there's an undersupply of space, there is constant demand, and as a consequence, retail is actually delivering what we think a very compelling argument. We also have exposure to healthcare, demographics, ageing population. We think that's a fantastic area. Again, limited supply. We have data centres, self-storage. So that's, to us, the value proposition, that you're getting some great real estate, limited supply, robust tenant demand that is going to drive, we think, some pretty good returns going forward.
I want to stick with that. You talked before to ageing populations, demographics, as well as data centres, which is obviously playing into the AI thematic, which is just taking over the world in 2024. What are some of the major trends you are seeing in listed property markets right now, and how are they presenting opportunities for investors?
Well, the themes that people have been looking at the last couple of years have been beds, sheds and meds. So the beds is your residential, where there's a shortage and rents have been growing in real terms. It also includes, as I say, student housing. Meds being seniors housing predominantly. Hospitals not so much, but more senior housing. So this is, aged care or nursing homes, low skilled nursing homes, where obviously people are getting to a stage of their life where they need assistance, and so these are facilities that are enjoying very good demand. And again, not a lot of competition but coming on stream. So, and then last but not least is the sheds. Well, what we're seeing in that area is logistics, warehousing, where there has been good growth, but also included in that you can put data centres. So they've been the key drivers in real estate. The one that we're a little concerned about is the warehouses. We've seen a huge supply response. We've seen a massive amount of development of new sheds. Now, as a consequence, vacancy rates are starting to tick up. And if we do see a slowing economy, especially for goods, then we think vacancy rates are going to start to really weigh on rents. So we don't have a huge exposure Relative to benchmark, we're very underweight in sheds, but we do have an overweight to data centres. There's only a couple of really what we consider to be leading players in data centre landlords, Digital Realty and Equinix. And clearly, they've been benefiting for quite some time, but obviously the AI issue has really ramped up the demand in the last, call it 12, 24 months.
You've talked a lot about this really attractive supply-demand imbalance in listed property markets today. That said, listed property still remains quite unloved by the market. What needs to happen for that situation to change?
Well, I said earlier, it's not about interest rates, but there's no doubt that helps, right? Because if people have more confidence about the finance side of it, that'll give them more confidence to make a long-term investment that real estate requires. So I think that stability of interest rates in the finance market will certainly help in a number of aspects. Look, for us, when we've seen real estate really in fashion in the past, it's been because there's a realisation that people have been overpaying for other parts of the investment universe. And then all of a sudden they realise, the REITs are basically doing as they said they do. And we've underappreciated the qualities of what they do. So it may well be, that there's some turmoil in the technology space, antitrust legislation in the US, the breakup of some of these organisations, just like we saw with the oil companies broken up many decades ago when they were the hot part of the economy. So I think it's, I can't tell you what will be the catalyst. We're not a catalyst investor. We just look at the long term and say, this is a space that does deliver consistently over the long term. And right now, as you said, it's particularly unloved. And that's fine by us. We'd prefer to be underloved than overloved, because overlove really means you're setting yourself up for a fall. Right now, we're pretty comfortable being, if dare I say it, the ugly duckling.
It's kind of been a theme throughout your career. I don't know, you come full circle. You started wanting to work in property because it was unloved, and now once again, it's unloved again. Yeah, look,
that's the challenge of being in the market, not overselling what you do, and that's something I think we're all at risk. There's an old saying, to a tradesman that only has a hammer, everything looks like a nail. Right? And I'm clearly a sector specialist, so I've got to be very careful about recognising we're a very small part of the universe. But it does seem, as you said, we're particularly unloved at this point in time, and that to me is fine. I don't mind that. I mean, I'm invested in the space. It's going to give me a nice return profile that I sleep at night with. So. Yeah, don't worry about it. Don't overthink it. The market will love it again at some point, and when it does, then you've got to try and calm expectations.
It really demonstrates, I guess, the market cycle.
It's a cycle.
Market cycle.
Exactly right, Ali. Yeah. You're spot on. I mean, real estate is a cyclical game, and right now you're buying at a cyclical trough. Fine.
And they do say buy when there's blood in the streets. Okay, Andrew, we've come to the final 3 questions of the podcast. These are meant to be a little bit of fun. They're meant to be a thought experiment. First question, what is one thing you think investors are getting completely wrong about property markets?
Completely wrong. That it is cyclical. And when sentiment's bad, it will... that's generally the time to get enthused. And so the cynicism out there at the moment is, I think, there's some, I guess, veracity to it, if that's the word, in terms of, we've seen, as I say, we've come off an incredible period of QE and QT. But look, for us, what people are getting wrong is they're just underestimating, at the end of the day, intrinsic value. And that, to us, is what it all comes back to.
Resolution Capital has just celebrated its 20th anniversary, as I mentioned at the top of the podcast. As a founder, what do you think has been one of your best investments of all time, or of that 20 years?
Look, the best investment, gosh, that's a tricky one, Ali. I mean, that's trying to choose the favourite child, isn't it? I mean, look, there's been obviously some investments that have done better than others, but... Wow. I think the fact that we've been, I hate to say, and this is probably a bit boring, but I think overall, it's just the fact that the portfolio that we've invested in, we've just seen such great real estate and great operators that people don't appreciate. If I mentioned global equities, people rattle off 20, 30 great organizations, whether it's NVIDIA or Amazon or Meta or Google or Alphabet. If I mention global REITs, people struggle to name one or two, but some of the great vehicles that we've seen really unfold over the last 20 years, Derwent London, it's an office play, but these guys are just so astute. They're incredible. The quality of what they do, the space they deliver to tenants, the creativity with which they approach the space, they keep it simple. Federal Realty in the US, which owns extraordinary mixed-use shopping centre, retail, office, hotel precincts. So these are the sorts of investments that for us have been fantastic to watch unfold and create so much value over a long period of time.
Is there any Australian REITs that come to mind?
Look, it's one that we're not in is Goodman. I mean, I think what Greg Goodman and the team at Goodman Group have done is extraordinary, and we've been wrong. We've been horribly wrong, but thankfully it hasn't killed our performance. But we just think the market loves it too much. But you know what? He deserves a lot of love because what he's delivered now is extraordinary. I mean, that platform was in diabolical trouble during the GFC, and Greg, to his great credit, he addressed the issues. He stuck to it. He didn't walk away like some. He believed in what he was doing, and he pivoted the business to be one of the great global real estate platforms, and full credit to them. But we're not invested in it. But elsewhere in Australia, look, there's some terrific platforms here, some which we own, some which we don't. I mean, Arena REIT, which is a childcare REIT, we have it in our domestic strategy, not in our global strategy, but that's a great little platform. The Westfield Centre Group platform is one of the best shopping centre portfolios in the world. Vicinity with Chadstone Shopping Centre is probably arguably one of the top shopping centres in the world. So look, there's quite a few here, but when we've got a global opportunity set, it's a pretty high hurdle.
Okay, last question for today, Andrew. If the market was going to close for the next 5 years and you could only own one listed REIT, what would it be and why?
Okay, close for the next 5 years and only own one. Well, I guess it'd have to be supermarkets, right? Because, if the market's closed, it tells you there's some pretty big problems out there. So I'd say you've got to eat.
It's more like it's meant to be, it could be a defensive.
I know what you're saying. I'm overcomplicating.
It doesn't really matter.
Look, we don't know. Again, I'm not going to name because you know what? Whatever I say, it's not going to be the right one. That's why you own a portfolio, and that's what we've learned over the years. You highlight stocks, and it tends to be the wrong one to highlight. We have a portfolio of about 40 great platforms. Some will do well, some won't. But at the end of the day, I'll name the portfolio. That's the thing to be invested in for the next 5 years, not an individual stock, because we're just not that smart.
I'm going to push you for one individual REIT. Unfortunately, that's the name of the game with this final question. Just one that you feel, either it could be something that you feel like your money would be safe in over the next 5 years, or one that you think possibly could have the best growth.
Ali, you can push you all you like. I'm not going to, I tell you.
Oh, no.
RCAP, it owns 45 of the world's best REITs. That's the one stock to own for the next 5 years.
Okay, well, thank you so much for your time today, Andrew. It was a really interesting chat. I'm really grateful for your time. Thank you again.
Thanks, Ali.